The world of investing can feel like a total maze, right? There's just so much conflicting advice and all these complex strategies being thrown at you. So, in this explainer, we're going to build a roadmap, a way to cut through all that noise by finding the one thing that truly matters, your own personal investment philosophy.
So, where do we even begin? Well, it turns out that every single investor out there, and I don't care if you're just starting out or you've been at this for decades, you face the exact same fundamental problem. It's a challenge that gets right to the heart of why we even invest in the first place. I mean, this is it, isn't it? Think about it. Who gets into investing hoping to be just average? No one. We all have that dream of being exceptional, of finding that secret edge, and becoming a super investor. That ambition is what drives us, but it's also the very thing that makes us so vulnerable. Vulnerable to what, you ask? To what we could call the investment town square. Just picture it. You're standing in a massive, noisy marketplace, and everywhere you look, there are financial gurus on soapboxes, all shouting at once, each one claiming they have the secret formula to riches. It's loud, it's confusing, and honestly, it's completely overwhelming. And what are they all yelling about? Totally contradictory stuff. Over in one corner, you've got the value investors, the Warren Buffett disciples, telling you to buy solid, predictable businesses that gush cash. But then, on the complete other side of the square, you have the growth crowd shouting that the old rules are dead and you have to bet big on technology in the future. So, who do you listen to? Well, the answer is you listen to yourself. But before you can do that, you need to build the tool that helps you filter out all that noise. And that tool is your investing philosophy. The best way to think of it is like the rudder on a ship in a crazy, stormy sea. It's the one thing that keeps you on course, no matter how wild the waves get. So, what exactly is an investment philosophy? Let's be clear, it's not just a strategy or a few rules of thumb. It's way deeper. It's your own coherent, foundational set of beliefs about how markets really work, why they sometimes mess up, and this is key. What common mistakes you think other investors are constantly making? And what happens if you try to invest without one? Well, without that rudder, you're just adrift. You get pulled in every direction by the latest fad, which makes you easy prey for financial charlatans. You end up jumping from one hot strategy to the next, racking up a ton of transaction costs and taxes, and you ultimately end up with a strategy that is completely wrong for your personality and your financial goals. Okay, so how do we start building this thing? Well, it all begins with the absolute foundation, the first and most important building block, your understanding of financial risk. Before you can even think about returns, you have to get really, really clear on what you believe risk actually is. Now, in finance, risk isn't just about the scary thought of losing money. It's really all about uncertainty. A riskless investment, like you see on the left, is kind of boring, right? What you expect to get is exactly what you get. But a risky investment, well, that's where things get interesting. The actual return you get could be way higher than you expected, or it could be way, way lower. And there's a brilliant way to think about this duality. The Chinese symbol for risk is actually made up of two separate characters. One means danger, and the other means opportunity. See, risk isn't just some hazard we need to run away from. It's the price of admission for the opportunity to earn higher returns. You can't have one without the other. No danger, no opportunity. Okay, so this leads to a really big question. If we agree that risk is this two-sided coin, part danger, part opportunity, how in the world do we measure it? I mean, how do you actually put a number on that uncertainty? Well, that simple question kicks off one of the biggest and longest-running debates in the entire world of finance. This great debate has basically split the investing world into two big camps. For decades, academics and investors have been arguing about the best way to quantify risk. And let me tell you, their approaches are worlds apart. So, in one corner, you've got the academic, market-based view. The big word you'll hear is beta. This is all about measuring how much a stock tends to move up or down when the overall market moves. In the other corner, you have the business-focused view, made famous by value investors. Their key concept is the margin of safety, which is all about protecting yourself if your own analysis turns out to be wrong. Let's dig into beta for just a second. The key thing to understand is that it's not a measure of every single risk a company faces. Not at all. It's specifically trying to measure the risk you can't get rid of by diversifying. The big economy-wide stuff like recessions or sudden interest rate hikes that affect pretty much everyone.
A company can have plenty of its own unique problems, but if they aren't tied to the macroeconomy, it might still have a low beta. Now, margin of safety. This is a much more practical, gut-level concept. It's actually really simple. It's a buffer. You do your homework, you estimate what a business is truly worth, its intrinsic value, and then you simply refuse to pay anywhere near that price. You insist on buying it at a significant discount. That discount, that's your margin of safety. It's your protection in case you are wrong about something.
Okay, so we've got these two huge competing ideas about risk. We've got beta on one side and margin of safety on the other. So, which one is right? Well, the answer to that question is what brings this all home. It's about crafting a philosophy that's a perfect fit for you.
All right, this is where the rubber meets the road. Deciding whether you're a beta person or a margin of safety person isn't just some boring textbook debate. It has everything to do with who you are, what your personality is like, and what you're trying to achieve as an investor. To figure out your fit, you have to do a little self-assessment, and you've got to be really honest with yourself. First, how much do you truly freak out when the market drops? Second, what's your time horizon? Are you investing for a down payment next year or for retirement in 30 years? Third, how much money are you working with? And finally, how are taxes going to affect your returns? Your answers to these questions are what will point you toward the philosophy that's right for you. And this, right here, is probably the most important takeaway from all of this. There is no single best philosophy that works for everybody. It just doesn't exist. A strategy that makes one person a billionaire could lead someone else to ruin. Real, lasting success in investing is all about alignment. It's about finding the philosophy that is a natural, comfortable extension of who you are. So, as we wrap this up, and to help you get started on this journey, I want you to do one thing. Forget all the noise, forget all the gurus in that town square for just a minute, and ask yourself one simple but powerful question. Deep down, what do you truly believe about how the market really works? Your answer to that, well, that's the cornerstone. That's the very first block you need to lay to build an investing philosophy that can last you a lifetime.